The day the market broke, lessons from history's worst fads. In 1720, the smartest man on earth made the single dumbest financial decision of his life. His name was Sir Isaac Newton, the genius who discovered gravity, invented calculus, and reshaped human history. Yet, when it came to the stock market, his brilliant brain was completely hijacked by four simple letters: FOMO. If the world's greatest mathematical genius can be wiped out by market hype, what chance do the rest of us have? In a matter of months, Newton lost almost his entire life savings in a reckless speculative frenzy. Welcome back to FinHub USA. This is the psychology of ruin and riches. Today, we unpack the dangerous anatomy of market bubbles and how to survive the urge to chase easy money. It all began in London with an enterprise called the South Sea Company. The company promised massive, guaranteed profits through exclusive trading rights across South America. In reality, the company barely traded any goods at all. It was powered by pure, unfiltered government hype. Newton, being a rational thinker, recognized the opportunity early and bought a modest bundle of shares. Within just a few months, the stock price doubled, and Newton made the disciplined choice to cash out. He walked away with a 7,000-pound profit, worth millions of dollars in modern purchasing power. He was disciplined. He was rational. He had successfully beaten the market. But then, the most dangerous emotion in all of finance took over: envy. Over the next few months, South Sea stock didn't slow down. It went completely vertical. Every single day, Newton watched his less intelligent friends and neighbors become overnight millionaires. Clerks, farmers, and politicians who knew nothing about economics were suddenly buying estates and carriages. Legendary investor Charlie Munger once said, "The world is not driven by greed, it's driven by envy." Newton's mathematical discipline completely shattered under the weight of feeling left behind. In August of 1720, at the absolute height of the market mania, Newton surrendered to the madness. He jumped back in, dumping virtually his entire life savings into South Sea stock at the highest price in history. He bought at £1,000 per share, and almost immediately the music stopped. Company insiders began quietly dumping their shares, and panic spread through London like wildfire. Within weeks, South Sea stock went into an uncontrollable death spiral, crashing by over 85%. Newton lost over £20,000, equivalent to more than $4 million today. He was so deeply humiliated that for the rest of his life, he banned anyone from uttering the words South Sea in his home. He later uttered his most famous confession: "I can calculate the motion of heavenly bodies, but not the madness of people." 300 years later, the technology has evolved, but human psychology remains identical. From 17th century tulip mania to the 2000 dot-com crash, every bubble operates on the exact same engine. It is called the greater fool theory. In a bubble, people don't buy an asset because it generates cash flow, earnings, or real intrinsic value. They buy solely on the hope that someone else, a greater fool, will pay an even crazier price tomorrow. And without exception, every single bubble pops the moment the market runs out of new fools to buy. So how do you protect yourself from the psychological trap that crushed Isaac Newton? First, develop total immunity to other people's overnight success. If you don't understand the underlying business model, you aren't investing, you're just gambling. Second, stick to assets with real cash flows, sustainable earnings, and long-term compounding power. Real wealth is built through boring, predictable patience, not frantic lottery tickets. Hit that subscribe button to join FinHub USA and protect your portfolio from psychological traps. So what happens when you master discipline and decide to opt out of the corporate rat race entirely? In our next episode, we explore the explosive rise of the FIRE movement: financial independence, retire early. We'll break down the exact math everyday people are using to retire decades ahead of schedule.